Welcome to lecture 19 of International Finance. This is our a new chapter on the topic of balance of payment. So we are going to discuss balance of payment and its components, and then we are going to see how this balance of payment or its components would affect the exchange rate. Moving towards the content, so first we would see what balance of payment is. Then within balance of payment we have a current account, which is a sub account of balance of payment, and then we have a capital account. So we would look into these two sub accounts. Okay, so what balance of payment is? It basically is the record of value of transaction between a residence, business and government with the rest of the world. So if you are familiar with the accounting terms, where we accounting book where we record the transactions that uh, business that takes place in a business. But in case of balance of payment, it's also an accounting book, but this accounting book records the transaction of one country with another country, right? Uh, so transactions between one country and another country. So for example, if Pakistan is going to maintain a balance of payment, then it would record all the inflows of foreign currency and all the outflows of foreign currency, right? So all inflows and outflows from rest of the world, from any other country, not one specific country, but all the other countries. So what balance, if we come back to this definition, uh, so the country's balance of payment, so this country's balance of payment means that each country would have its own balance of payment, and this balance of payment would record the value. It's important to understand that it would not record volume, that how many goods are bought from another country and how many goods um, the world have bought from us. So we would not record the quantity or volume, but rather we would record the value. So it would be in terms of currency, right? Either in terms of dollars, rupees, or any other currency, but it would be in terms of value of the transaction between a country's residents, business, and government with the rest of the world. So it's not necessary that it would just be the transaction of Pakistani government with the rest of the world, but it would also include one business buying products from another business, one business buying the raw material from another business out of this country, one resident buying some property in another country. So 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 uh, so whatever a country's national, its business or its government buy or sell some products from the rest of the world, then its value would be recorded in this balance of payment. So it's just an accounting book to record the value of transaction between countries. So this balance of payment, this whole account is further subdivided into two accounts. So we have current account and we have capital account. So these are two types of accounts within balance of payment, and we would explore each of this type of account. But before we move forward, let me first tell you that this balance of payments have two sides. One is the credit side and the second one is the debit side. If you are familiar with the accounting terminology, we have debit side and we have credit side. So the credit side of this balance of payment would record all the inflows of foreign currency or foreign exchange, right? All the inflows of foreign currency, or in simplistic idea, it is the inflow of of cash, right? So if a company from another country buys products from a company in Pakistan, then it would be a cash inflow in Pakistan. It would be recorded on the credit side. And obviously, the debit side would then be the outflow of foreign exchange, right? So it would be outflow of cash. Okay. So if so, this is somewhat similar to the revenue account in accounting. So just to give you an idea, do not confuse this with the exactly revenue account. But in revenue account, if you remember, um, when the revenue increases, it's credited. So in essence, when the inflow of cash increases, we are crediting it into the balance of payment, and when the revenue decreases, we debit it. So just to give you an idea, if you are familiar with this revenue account in accounting terminologies, then just to remember and have a reference point, you can compare it with the revenue account. Okay, so we are going to divide this balance of payment into first current account. So current accounting is nothing but this balance of payment being divided into two parts. So the first part is current account. So this current account further have three parts. One is called the merchandise, goods and services, or normally it is referred to as balance of trade. Then we have factor income, and then we have unilateral transfer or just transfer. So starting with the first part of this current account records the purchase and sales of goods. So if we purchase goods from another country, that we call it imports, and if we sell goods to another country, we call it exports. So any imports and exports are recorded within this current account. This is just one part of this current account, but all the imports and exports are recorded in this current account. Not just goods but services. so um, so for example, there is a service of tourism, right? So if a foreigner visits Pakistani uh, you know tourist places, then we are essentially exporting our tourism. It's a service. And if a Pakistani national visits some other country for tourism purposes, then we are importing tourism. But it's not a good, it's a service. Similarly, if a foreign company buys some kind of technical services from us, from a company operating in Pakistan, then that would be import of services. The idea is that this current account not just records the import of goods, but also the import or export of services. So both the visible products, the visible items, and the invisible items are recorded here. Okay, it's called trade for this specific reason. What would happen if exports are greater than imports? We would have a surplus balance of trade, BOT. So we have more cash flow coming in and less cash flow leaving the country. So our exports are greater than imports. And if our exports are lesser than imports, then we have a deficit in balance of trade. Now, recently you would have heard of this terminology quite often because it's quite often reported in the news. They would say that current account is in surplus or it is in deficit. Nowadays you would hear more that current account is in surplus, which means that exports are greater than imports. It doesn't necessarily mean that our exports have increased. It might also suggest that we have imported lesser goods. But what would be its impact on the exchange rate? This is what we are more interested in. See, if we export goods, what happens is that we get foreign exchange. So, for example, if we are exporting products to to US, right? So our so we will get dollars, and the supply of dollars would increase, right? So if the supply of dollars would increase, okay. So obviously this Pakistani firm exporting the products, getting the dollars, what would it do with dollars? It would convert it into rupees. Why? Because it needs rupees to pay in salaries and to run the other expenses. This is just an hypothetical scenario. So what would happen is that it would sell the dollars in exchange, and so the supply of dollars would increase, and it would buy rupees, so the demand of rupees would increase. So if demand of rupees is increasing and the supply of dollars is also increasing, it would put downward pressure on dollars and upward pressure on rupees. And what would happen to the exchange rate? Obviously rupees would appreciate, right? Rupees would strengthen. So if currently we have 160 rupees per dollar, so we might see an exchange rate of 150 rupees per dollar. This is rupees being strengthening. So that may be one of the reasons that that we are more interested in this exchange rate. So if you see that current account is going to be in surplus, then you might expect that the rupees would appreciate. But in contrast, if you see that this current account is going to be in deficit, then you would expect that the rupee would depreciate. Okay, so in short, within current account, we record merchandise, imports and exports of goods and services. And would essentially like to see this scenario. Factor income. This factor income records the inflow or outflow of income. Okay, so what do we mean by inflow or outflow of income? So in this case, for example, if a US citizen buys some shares in Pakistan, right? Say for example, this buys the shares of Angro Corporation. Angro Corporation would pay dividend, and this dividend would go to this US citizen, right? So in this case, this dividend is the income, right? This income being sent to a foreign citizen. Now these kind of aspects, for example dividend or interest, they are recorded in the factor income part. So the second component of current account is factor income, which represents the income, that is the interest or dividend payment received by investors on foreign investment in financial assets, say for example stocks and bonds. So the factor income received by a US investor reflects the outflow of funds from Pakistan. So in this case, the Angro Fertilizer paying the dividend to a US citizen reflects the outflow of foreign currency out of Pakistan, right? And similarly, in previous few months we saw that Pakistan interest rate was around 14%. That was quite an opportunity for foreign citizens. So what most of the foreign citizens did is to exploit this opportunity. They deposited their money into Pakistani banks, and obviously the Pakistani banks would pay interest to these foreign citizens. That again would be a cash outflow of foreign exchange. So in another scenario, let me just clear this code. In another scenario, if for example a Pakistani citizen bought some shares of, say, a Microsoft, then Microsoft paying the dividend to this Pakistani citizen would be a cash inflow in the current account of Pakistan. It would be cash inflow in the current account of Pakistan, but it would be cash outflow in the current account of US. So in short, factor income records the income component, just the income component. Then we have transfers. So transfers, these are also called unilateral transfer, and unilateral means one-sided. And they are called one-sided for a reason. What this transfer or unilateral transfer would record is the payment such as aid, right? So for example, there was an earthquake in our country, and foreign governments paid some aid, then that aid would be recorded in transfers. Then there are some grants, scholarships, right? Some gifts are paid to the delegates that visit foreign countries. These gifts or grants or aids are recorded in transfers. Why are they called unilateral transfer? Because in these other aspects, there is a two-way transaction. So if someone buys good from us, they pay us, right? And we give them goods. So there is a two-way transaction, right? But in unilateral transfer, if a foreign country is paying us gifts, then we are not paying them something back in return, right? Similar is the case with aid and grants. So that's why we call it a unilateral transfer. Okay, so let's move to the next component. Again, as the case was with the balance of payment, cash outflows are debit and cash inflows are credit. Okay, so a few examples. An ABC corporation purchases products from a US firm to be sold in Pakistan. So this is a Pakistani firm. It purchases a product from US corporation, and these products would be sold in Pakistan. So what is happening is that cash outflow from Pakistan, because this ABC corporation is purchasing, it is importing products, right? So import would be a cash outflow from Pakistan, and it would be debit in balance of trade or balance of payment. Similarly, a Chinese government pays Pakistani firm for consultancy fees. So Chinese government did purchase some services from a Pakistani consultancy firm, and they paid us cash. So that cash inflow to Pakistan would be credit in the balance of trade. These examples are related to factor income. So if SBP sends interest payment to a Chinese commercial bank that purchased Pakistan's treasury bonds, these are T-bills that are auctioned by State Bank of Pakistan, right? And there is some interest paid on these T-bills. So if a Chinese government purchased some T-bills, now after some time the State Bank of Pakistan would pay them the interest. So that interest part, not the payment of T-bills, but just the interest part, which is SBP is paying the Chinese commercial banks, would be recorded into the factor income. You must be clear about this concept that this Chinese firm purchasing the bills, there would be say $1 billion paid to State Bank. So this would not be recorded in factor income. Rather, when the State Bank would pay the interest amount, then that interest amount would be recorded in the factor income because it just records the income component. This amount is 1 billion amount that Chinese paid to buy the T-bill would be recorded in the capital account, and we would discuss this one. So this would be cash outflow because a Pakistani firm, because SBP would be paying the cash, that would be a debit. Similarly, Pakistani investor receives dividend from a US firm. So this Pakistani investor receiving the dividend is cash inflow to Pakistan, and it would be credit. And the last is the transfer part. So Pakistani government provide aid to developing country for being hit by earthquake. So this is cash outflow from Pakistan, and it would be debit. And Chinese government provide grant to Pakistani scientists for working on certain projects. And this would be cash inflow to Pakistan, and again it would be credit. Just remember, whenever there is cash inflow, it would be credit, and this cash inflow would have a good effect on the currency. By a good effect, I mean that there would be an upward pressure on the currency, and upward pressure would lead to an appreciation in the currency. Whenever there is a cash outflow, that would lead to a that would be a debit, and it would put the downward pressure on the currency, and hence the currency might depreciate. I am using the word might because it is not necessary that it would happen. For example, Pakistani government providing aid for the earthquake to another country is just a small part, and this small part do not have much effect on the exchange rate. And then there are multitude of factors that would affect. It's not just exports or imports or the factor income. There are other multitude of factors that play the role. Okay, we come to the next component, which is the financial and the capital account. And basically these financial and capital account are two separate accounts, but we have clubbed these into a single account. And this is what is done by most of the books because this capital account is quite a small portion of balance of payments, so we normally club them. So within this financial account, we have three further aspects, or rather two aspects. One is the foreign direct investment, and the second is the portfolio investment. Okay, this foreign direct investment is the amount that is paid that is the investment in the fixed assets, right? For example, when Zong purchased a firm in Pakistan, what they did is that they purchased the fixed asset of this firm. So this is a foreign direct investment, right? Similarly, if for example and this Toyota company installs a new car assembling plant in Pakistan, then that would be a foreign direct investment. So foreign direct investment represents the investment in fixed asset in a foreign country that can be used to conduct business operations, right? So they invest in fixed assets, they buy businesses. That buying of businesses or investing in fixed assets would be foreign direct investment. Now, as compared to this foreign direct investment, in portfolio investment, only the transactions in the financial assets are included, right? So they do not buy the business. They do not buy the business, but in here they buy the business, right? Here they just buy shares or bonds or any other financial assets. Remember, not the real asset, just the financial assets. So in previous example, if you remember, I mentioned that a Chinese firm, Chinese bank purchased T-bills from State Bank of Pakistan. So, and the amount was $1 billion, right? This $1 billion is used to purchase bonds. This would be recorded in portfolio investment. And any interest that is generated from this bond would be recorded in factor income. Now you would have got the idea. So any purchase of financial assets would be recorded in portfolio investment. Any purchase of business or fixed asset would be recorded in foreign direct investment. And any income generated from these financial assets would go towards factor income in the current account. So similarly, if a Pakistani individual, a Pakistani investor buying shares of Microsoft, then this would be an outflow in portfolio investment, recorded in portfolio investment, but this would be an outflow. But the dividend that this Pakistani investor would receive from Microsoft would be a factor income, and it would be recorded in the current account. So purchase of financial assets would go towards portfolio investment, and the income generated from these financial assets would go towards would be recorded in the factor income. Now again, the similar rule would apply. So I discussed an example that in Pakistan there was an interest rate of 14%, and it was for the reason, obviously there was a reason to control inflation, but one of the reason is to lure the investor, the foreign investor, to deposit money into Pakistani bank. And when they would start depositing money, so there would be an inflow of foreign currency, right? And when there is an inflow of foreign currency, and if I make it further easier, what they do is they would sell this foreign currency. Let's say they would sell this dollar. So the supply of dollar would increase. This is the process that would happen. They would buy rupees to deposit them into Pakistani banks. So demand of rupees would increase, and this would put an upward pressure on rupee, and hence the rupee might appreciate. Okay, so the simple idea is when there is inflow of cash, that leads to an appreciation of local currency. When there is outflow of cash, that leads towards the depreciation of local currency. So in this case, a higher interest rate led towards the inflow of cash, and hence appreciation. But there was a criticism on this idea, and it was called that it is a hot money. And the reason for this was that as soon as you decrease the interest rate, so for example nowadays it's 7%, as soon as you decrease the interest rate, all of the capital would flee the country, and so that advantage would not be sustainable, right? So that's why foreign direct investment would be more beneficial rather than portfolio investment. And the same is the case with foreign direct investment. When foreign company coming to Pakistan would bring foreign exchange, so they would convert that into rupees to pay the salary, to buy the assets. So the supply of dollars would increase, and the demand of rupees would also increase, and when that would happen, the rupee would appreciate. Right? So this is the simple mechanism. Other capital investments are also there, but that is a small portion of this financial account. so which represents transaction involving short-term financial assets such as the assets in money market between countries. So this is related to financial and capital account, and there is one last aspect to this lecture, which is autonomous and accommodating items. So there are two type of items. One is called autonomous items that take place due to economic motives. For example, import, exports. These take place due to economic motives to earn profit for buying and selling activity. But what would happen is that, say for example, we have this current account and it's in deficit. That means that debit side is greater than the credit side. That means that imports are higher than exports. So if imports are higher than exports, then that means cash outflow is greater than cash inflow. Now where would this cash flow come from? I mean, if we have lesser cash inflow but we are spending a higher amount, where do we get this higher cash flow from? We get this from the other aspect of the balance of payment, which is the capital account. So to adjust this outflow, this deficit, we would, for example, borrow some amount. This borrowing of amount from another country would come into the portfolio investment. This would be an inflow, right? Okay, to balance this deficit in the current account. So this aspect is the accommodating item, because this accommodating item takes place in order to balance the balance of payment. It is called balance of payment for a reason, because as in accounting book, we do we balance the left hand side of the balance sheet, left and right side of the balance sheet, the two parts of the equation, we balance them. So similarly, we balance this balance of payment, and the deficit in current account would have to come from a surplus of the capital account.